Hi, and welcome back to another episode of The Mortgage Musketeer, where today we're going to be talking about loan to value. What does that mean? How is it calculated? Along with CLTV, which is combined loan to value. So we're going to break that down and let's jump into it. So loan to value is actually a very simple concept that is confusing only in how it is applied, and I'll explain how. But first of all, loan to value is nothing more than your loan amount versus the value of the home. So the loan amount is going to be whatever the sales price is minus your down payment. So how much of your down payment is required, and here's a link, is going to come off of the sales price, and that's going to give you a remaining loan amount. That loan versus that sales price, which is also the value, is going to determine what your loan to value is. And at the end of this video, I'm going to break down examples of how to calculate each one. But first I want to explain that a little bit more, because when you buy a house, the sales price is the value that we're talking about, not necessarily the appraised value. So they're two different things, and that's where people get confused. So when you buy a house, let's say that you bought it for $200,000, that was the sales price. The seller got together with the realtor and they determined that, looking around at comparable sales in the neighborhood, that they're going to be able to sell it for $200,000. So that's what they put on the sales price. You just buy it for $200,000 and you're going to put down, let's say, $20,000. Okay, so you have a $180,000 loan amount, and then you have a $200,000 sales price. But when you go to do the appraisal, it appraises at $210,000. Right? So then people think, oh great, now I can get a loan for $210,000, and now I'll just take out an extra $10,000 and maybe do some repairs or something around the house. It doesn't work that way. When a lender is going to lend you money, they're going to go off of the sales price or the appraised value, whichever is lower. So understanding that, when you go to get the house, you can't think, well, hey, I'm getting a good deal. Like, let's say, for instance, if you buy a foreclosure. This happens all the time. People buy a foreclosure, they get a really good deal, and they think that I'll just get a loan for, $30,000 more, and I'll use that money, to be able to do whatever I want with it. You can't do that. Now, there are loans you can. Those are called renovation loans. But a typical loan, you can't do that, because that money that's out there is equity in the home. So let's go back to the $200,000. So you bought the house for $200,000, it appraised for $210,000, but all we do is say, high five, congratulations, you have $10,000 of equity. But as I've mentioned in the past, equity is intangible money unless you do a cash out refinance to pull that money out, or you sell the house for $210,000, and then you can realize that money. But otherwise, it's intangible money that's just floating out there that is awesome for you because it means that you have a higher value. But in the case of a sale, a purchase, the loan to value is going to be based upon the actual sales price minus your down payment, not the appraised value. When you get a refinance, you're living in the home and you get an appraisal, the loan to value is based off of the appraised value. Two different things, and really that's just where people get confused. So understanding where you are, if you're talking about a refinance, yeah, you can realize your equity. And that's also why when loan officers will build a refinance, they'll ask you how much it's worth. You say, well, appraised for $210,000. They might try and build it for like $215,000. Appraisers will oftentimes only appraise it for whatever value you put in there. So sometimes they try to stretch it a little bit, and the appraisers are pretty good about that, but they'll cap it if it's not enough. All right, they'll stop it. But they're just trying to maximize your equity. And the reason that we want to maximize your equity, especially in a refinance, is for loan to value. What is the loan amount versus the actual value of the house? Everybody really wants to achieve an 80% loan to value, meaning that you have 20% of equity in the home. And if you do that, that means you've got enough skin in the game where you can get rid of your mortgage insurance. And mortgage insurance is really where it all comes down to, trying to lower it. So let's talk about some examples. All right, let me break it down. Okay, so let's say that you bought a $200,000 house and you put 10% down. So you've got a $180,000 loan. So your down payment was 10%, meaning that your remaining loan to value is 90%. All right, so all we did was we took the 10%, which was 20,000, right? That's your equity, which leaves you with a loan amount of 180. Divide 180 by the $200,000, and it gives you a 90% loan to value. All right, so that's all that the initial calculation is. It is whatever your down payment is, leaves a remaining amount that's going to be your loan, and that loan is then divided by the sales price on a purchase. Okay, so and you can apply that to any scenario. It's nothing more than the loan amount divided by the sales price. Okay, now let's say that this is a refinance. So if we did that, then let's say you bought that same house and it appraised at 210. So you have a sales price of 200,000. It appraised for 210, but we can't use that because it's equity, but we know it's out there. And then you had put 10% down, so that's 180. So let's say a year later, you're going to go refinance this home, just a rate and term refinance. And now let's say, I'm making this number up, let's say your loan is $175,000. That's what's left. You've been making payments, you paid it down, it's $175,000. Okay, again, just made that number up. And when you bought the house, it appraised at 210. Let's say that the market took off, right? I mean, it's been a great market, and the value of your home increased, and now it's worth $220,000. So because your home value increased, that's your actual value on an appraisal. So we go out and we appraise it. It says it's 220. You have a $175,000 loan amount. You now have a 79%, 79.5 loan to value, and we can get rid of your mortgage insurance, right? Whereas when you initially bought it, you put 10% down, you still had a small amount of mortgage insurance on it. So this is a really powerful way to look at the value of your home and taking advantage of that equity. That's on a rate and term, all right? Now, when you're dealing with a cash out refinance, most of the time they're only going to go to an 80% loan to value. So you'd have to have more equity in the home to pull money out. Not always the case. You can do FHA, and there's some other ways that you can get cash out. But if you want to avoid the mortgage insurance, that's what you would need. So those are just a couple really quick examples on how to do it. Now let's talk combined loan to value. Let's say that you had put 20% down, okay, on that $200,000 house. So you had a $160,000 loan, which gave you an 80% loan to value on $200,000. So you also decided that you were going to get a $15,000 pool, and you had a home equity line of credit. All right, so that was $15,000 on top of your $160,000. So you have two lines of credit on there. You have your primary, which is your mortgage, and then you have a home equity line of credit, or a HELOC. That's essentially a second mortgage, right? So you're combining those two loans because they're both attached to the house. You have a combined loan to value, where you have combined loans of $175,000, and let's say again that it had increased to $220,000 in volume when you did the appraisal, in value when you did the appraisal. So you could do a cash out refinance to consolidate those two and have one loan and still have an 80% loan to value and not have any mortgage insurance. So if you didn't do that, and if the value wasn't that high, your combined loan to value may be too high, right, in order to do a rate term or cash out refinance. So it just depends. So those are things to know and be able to calculate to understand how that comes together. Most of the time, a combined loan to value is really going to come into play if you're not going to pay that off. If you want to hold on to that and you're going to refinance, then that second loan, that HELOC, has to be subordinated to a new primary loan, which is just a paper trail. But it'll become a combined loan to value, and that's where that comes in. So unless you have a second mortgage, you don't have to worry about it. But if you do, that's how you calculate it. All right, hopefully that answered all of your questions on what is loan to value. It is directly corresponding to your down payment or to the appraised value on a refinance. If you have any questions, leave the comments below. And until next time, it's all for one and one for all.